All right, I want to give a quick introduction to an accounting financial statement that is important. And whether you realize it or not, you can have these sort of financial statements in your personal life and business life. So the one that I'm going to talk about today is called the balance sheet. And the way that I remember balance sheet is two different mnemonics. One is the balance sheet balances out on its two sides, and there are two sides. One is assets, and the other is the sum of your liabilities or debts plus your equity. And the analogy that I'll give to that is like buying a house. So imagine you bought a $100,000 house. That's your asset. But you need financing of an equal amount to buy that. And probably if you're going to put 20% down, that would be $20,000. And that's your own money. That would be considered your owner's equity. But of course, you're $80,000 short of that you need still. So you go out to a bank and get debt, or a liability. And that's the rest of your $100,000. So that's how the balance sheet equals out. Okay? The other way that I think about a balance sheet is it shows the balances in all of your accounts at any given time. Okay? So if you are really aggressive, you could create a balance sheet every day of the month, because your cash balance probably changes in your practice every day of the month. And it could show, the balance sheet would show the balance in your cash account every day. But it's just a monthly thing for most companies. So right here I'm showing the left-hand side of the balance sheet, which is assets, things you might expect. Cash account balances, and then the assets you bought when you bought the practice, tangible and intangible assets. And on the right-hand side is the financing that you used to buy these assets or fund them. So liabilities or debt, like credit card or your practice acquisition loan. And then the equity is the money that you put in of your own to buy the practice, or that you've earned. And that's the whole idea about having a business, is you've built up equity as the value of those assets has increased. So at the end of the day, those two sides equal. Okay? And in a previous segment, I talked about when you buy a business in the dental space, you're really only buying the right-hand side of this practice. Then the seller will take the price that you paid for the assets, pay down whatever liabilities they've got left. Whatever's left over is really their equity or gain in the business.